Please subscribe to the channel and press the bell icon to be notified of the latest videos. I'm Sage for Kalkai Media. Thanks for joining us for this educational series topic, what is a loan constant? The loan constant, also known as the mortgage constant, is a percentage that displays the annual debt payment on a loan as a proportion of the entire principal value. Borrowers could compare the loan constants of several loans before coming to a decision. The borrower picks the loan with the lowest loan constant to reduce debt service requirements, meaning the borrower will pay less in principal and interest over time. Frequently asked questions. How does a loan constant function? The annual debt payments on a loan are compared to the entire principal value of the loan. Thus, the debt payment on a loan is the total amount of money the borrower will have to pay to cover the repayment of the loan's principal and interest over a set period. In the business and financial worlds, the term principal has several connotations. The initial size of a loan or a bond is referred to as principal in the context of borrowing. For instance, if you borrow 80,000 Australian dollars, the principal will be 80,000. If you pay down 50,000 Australian dollars, the remaining 30,000 is the principal balance. Furthermore, the amount of interest you will pay on a loan is determined by the principal. For example, if your loan has a principal of 30,000 Australian dollars and a 10% annual interest rate, you will be obliged to pay 3,000 Australian dollars in interest for each year the loan is due. The loan constant is a percentage that may be determined for any loan. It enables analysts and borrowers to understand better the factors that influence a loan and how much they are paying annually compared to the loan principal. How to calculate a loan constant? Calculating the loan constant frequently necessitates a borrower obtaining the various terms linked with the loan agreement. The loan interest rate, total principal, frequency of payments, and length of payment are all included in the terms. Obtaining these loan term components enables the monthly payments to be calculated using a simple present value payment method. And once the monthly payments have been set, the loan constant can be calculated using the following equation. A mortgage borrower, for example, took out a 100,000 Australian dollar loan. The loan has a fixed interest rate of 7% and a period of 25 years. Using a payments calculator, the borrower would pay approximately 84,000 Australian dollars in annual debt service. Therefore, the loan constant for the borrower would be 84,000 divided by 100,000, or 8.4%. The periodic annual payments are calculated by multiplying the loan constant by the original loan principal. To compare the actual cost of borrowing, the loan constant can be employed. Loan constants are only applicable for fixed interest rates since variable interest rates have various annual debt service amounts dependent on variable interest. Therefore, if borrowers choose between two loans, they will typically choose the lower loan constant since it will require minor debt servicing. Before the invention of financial calculators, however, loan constant tables were frequently utilised in the real estate business because they made calculating monthly mortgage payments very simple. Borrowers can use loan constant tables to get pre-populated information about their loan with a quoted loan constant level. Thanks for joining us on the report. If you do like the information, please like, share, comment on the video below, subscribe to the channel and press the bell icon. You'll be notified of the latest videos. For more information, regular updates, please head to the website kalkaimedia.com. Sage here for Kalkai Media.